Are you ready to discover if Canoe EIT still reigns supreme as one of the top high dividend options? Once considered a must-have for income investors, now it faces stiff competition from the explosive growth of covered call ETFs. But fear not, we're about to dive into the details and find out if Canoe still holds its spot as a reliable income-generating stock. Hold on to your dividends, this is going to be a good one. Gone are the days when Canoe EIT Income Trust was just one of a handful of options for investors seeking higher dividends. The world of high dividend stocks has undergone a major shift over the past year, with covered call ETFs now taking center stage in many portfolios. These stocks do come with a little more risk than a traditional income fund such as Canoe, but as a trade-off for that, some of their returns are extremely good. They may just make you forget about Canoe EIT. I would argue that even with all of these new enhanced yield ETFs, there should still be room for stocks like Canoe, as it is never a great idea to over-diversify even into an ETF that offers better returns. The real risk with these newer funds is that we do not have a solid history to pull from to provide us an assurance that they are hopefully safe. I believe that many will turn out to be great additions and will build that history. There will probably be a stinker or two that may cost some of us a wee bit of capital. Seriously, kitten? The jury is still out, so these are stocks that need lots of due diligence and a little extra watching. Canoe EIT has that history to pull from, so it is a stock I have traditionally felt very safe holding. In fact, this is a stock I can give minimum supervision to, as they have been that reliable in my portfolio. I usually still do a deep dive every so often just to make sure their fundamentals are still in sync with the level of trust I afford them. Join the conversation. Let us know in the comments if you hold Canoe and how long have they been a part of your portfolio. Your participation is well appreciated. Don't forget to like and subscribe and stay up to date on future content, and thank you of course for that click. Canoe EIT Income Fund is a closed-end balanced fund that is owned and managed by Canoe Financial LP. The fund is designed to maximize monthly distributions and capital appreciation by investing in a broadly diversified portfolio of high-quality securities. These securities are primarily from the energy, financial, healthcare, and material sectors. Just over 50% of their assets are Canadian, with roughly 39% American and of course 6% international equities as well. On the negative side, you know there's always a negative side, there is the whole issue of return of capital. Canoe has used this in the past as a way of providing special distributions. When there is a return of capital, it in effect returns some of your own capital, which has the effect of lowering your average cost base. This means if you hold them in a non-registered account, you will effectively be paying more tax on capital gains when you sell. Or if they're down when you sell, you will actually benefit from your capital losses. This, of course, all becomes a moot point if you hold Canoe in your TFSA. So this all sounds, for the most part, pretty good. However, the true story is always with our good friend, Mr. Math. As usual, we will begin with a little surface data. Their market cap comes in at $2.08 billion, and they have a beta of 1.21, so they're not very much more volatile than the market average. Their earnings per share come in at 1.55, and they've got a price to earnings ratio of 8.90. That's actually not too bad, because when you look at the average in Canadian capital markets, it comes in at 9.10, so they're doing a little bit better than that average. They've got a price to book ratio of 1.10, which is fantastic. When we switch over and take a look at some of their cash, their revenue right now is $281.18 million, with earnings coming in, well, earnings is most of it, it's $234.64 million. A company like this, of course, does not have a lot of overhead, which is why their earnings are so high compared to their revenue. Interestingly enough, their past earnings have grown by 49.5% per year over their last 5 years. That's fantastic. That is a pretty good accomplishment. Their free cash flow comes in at $3.40 million. All right, switching over to their return on equity, that comes in at 12.00%. It is actually a little bit low. The industry average is 12.1%, so I'd love to see that get up a little bit. Their fair value. Now, their share price is currently listed at $12.67. If we run a discounted cash flow model, we get a price of $17.05. That means in regards to their fair value, they're 25.1% undervalued. That certainly does set them up for some growth in the future. Now let's quickly switch over and take a look at their dividends as well as their returns. Their dividend yield, it comes in at 9.397%. That is paid out monthly in the amount of 10 cents per share. Their payout ratio comes in around 74%, which is a little bit low. Normally they like to have that payout ratio a bit higher than that. One thing to add with their dividends, they do not miss dividends. They pay reliably monthly, but they have not raised their dividend in a very long time. It would certainly be nice to see them raise it a bit more, and if their payout ratio continues to stay on the lower side, that could be a possibility, though no guarantee. What you are guaranteed is that more than likely you're going to see that 10 cents a month for these shares continue to flow. Okay, so for return wise, their 3-year return, they rose from $6.02 to $12.67. That's a return of investment of 110.46%. That's not too bad. Their total return over that same 3-year period, once we factor in their dividends, that comes in at 170.27%. That's pretty good. In their 1-year return, so for their last year, they went from $13.90 to $12.67. That is a return of investment of negative 8.85%. You factor in those dividends, and we have a total return of negative 0.22%. I do need to point out that they have fallen a lot in the last couple of days due to the whole financial crisis created by the bank collapses in the US. That has made this look a lot worse than it really is, and I do expect them to bounce back pretty quickly once we get all of the banking issues in the US sorted out. Now, their 2023 returns, once again, these are also impacted by that financial crisis. They've gone from $13.48 down to $12.67. That's a return of investment of negative 6.01% and a total return of negative 3.78%. Once again, these numbers are skewed a lot lower. Keep that in mind. Let's switch over to debt. So their total debt comes in at $311.98 million, and their total equity comes in at $1.951 billion. That gives us a debt to equity ratio of 16%. That is absolutely fantastic. I do like that number a lot. When we break it down to short-term assets come in at $141.18 million, while their short-term liabilities come in at $118.72 million. Moving to long-term, their long-term assets come in at $2.15 billion, while their long-term liabilities comes in at $218.72 million. So that's not too bad. The only little slight downside there is their short-term assets of $141.18 million does not cover those long-term liabilities of $218.72 million. I know we've got nothing to really worry about with this company, but I really like to see the short-term assets cover the long-term liabilities, but in this case, it does not. I have been a solid supporter of Canoe for a while, and that does create the possibility for a little bias. I try my best to be impartial, but I also like to put all of my cards on the table before we jump in on that final verdict. So what is the final verdict? I still love Canoe, and even though there are many solid covered call ETFs that will pay me more, I am still very loyal to Canoe. Their fundamentals are really good. Canoe is the biggest holding in my portfolio at 8%, but I do have many covered call ETFs as well. It does not have to be a us or them scenario in any way, shape, or form. Good diversification leaves plenty of room for lots of different stocks. More specifically, with Canoe, they have great debt levels, and this makes for a lot of room to take on more debt in a prolonged recession. However, their management has been preparing for a recession, and I don't think they will need to take on a lot of debt to weather it. They've been making moves behind the scenes, for example, shifting a little bit more into fixed income as ways to be ready for that downturn if it comes. In the short term, they will have some growth as they bounce back from the current financial crisis, and there is a lot of potential for the share price as we finally move into a bull market. Their dividends are solid, and there is no danger of them being cut or not paying out those dividends. They have a really good amount of stability. On the mid to long term, there is a lot of growth predicted for Canoe over the next 5 years. Many analysts believe they can reach $20 per share. I am not sure if they will, but it does not seem impossible to me. This is simply put a great dividend stock with some half-decent growth potential in the short to mid-term, and I think eventually it may level out and become more of a dividend payer than a growth stock but I sure would love to be wrong about that. For now, Canoe has a home in my portfolio, and I have a feeling they will remain a channel favorite for some time to come. Keep the learning going. Watch my video on food royalty stocks linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner. See you in the next video.